Hi there, guys. This is Vinney Chopra again, back to you all with great ideas and points and what is really happening in real estate. And I hope you are able to get that free book. Of course, I've sold a lot of them, but I'm trying to give it away free. Just go to apartmentsyndicationmadeeasy.com, apartmentsyndicationmadeeasy.com. You get the book, digital copy, as well as audio copy. Then my second book, which is profitability book. Hey, positivity brings profitability. I've been a positive coach all this time. So that's also, you could get it for free, digital, as well as the audio version of it. My third book is coming out, which is our apartment syndication made easy. Senior living investing in made easy because of the silver tsunami. So please look forward to that. I'm almost done with that book. Thanks for liking, commenting on my 2 live shows that I do on Thursday morning, 9 a.m. and Friday, 9 a.m. live in 14 different social channels. It goes live. You can meet me there, talk to me, ask questions, and so on. With Walter Amarello on Thursday, a Abundance Mindset with Vinney Chopra, and then Vinney and Bo show on Friday, 9 a.m. Pacific again. And then other things that we are in TikTok and all the places. But thank you so much for your positive comments. We'll be giving away $1,000 in different gifts to raffles, and it's coming up. Those who like and share and give comments, 5-star reviews. If you like the content, then we would appreciate it. Oh my gosh, Vinny's always selling. Okay, we got great friend Kenny Wolf is in the house today, and we're gonna have fun. We're gonna have so much fun. Kenny is an experienced multifamily syndicator, the founder and CEO of Wolf Investments, and published author of Investing in Dream. I love it. Investing in the Dream, how to acquire multifamily real estate and attain total financial freedom. He invested in his first multifamily in 2010, very similar to me, like in 8 and 9. I got started with 14 units. He lives in Plano, Texas, just a great guy. And he's able to now build the whole company to 300 million worth of all the construction projects and the triple net leases and diversification. He's got lots of great nuggets for all of you. So Kenny, how are you, brother? Nice
Great.
to
How are you
have
doing,
you.
Vinny? Yeah, thanks for having me on.
You bet. So give us, some background about how you got into real estate. And a lot of people are aspiring to get in. You got in at the right time, like I did in 2008 and 9, when the economy was down. We have something like that happening right now, possibly, or maybe to some extent. Yeah.
Sure. Yeah, so I got started in oil and gas, as any good Texan does.
Yeah.
And so I got started on that. I was CFO at 28 years old of a startup oil and gas company.
Yeah.
We had one client. We were kind of wound that down after 3.5, 4 years, and then jumped right into multifamily investing. So my first 2 deals that were passive to learn the ropes, because I've never bought a single family rental in my life. I jumped right into multifamily. And so one was a big fixer upper, one was a value yield play. And then my third deal I did was a syndication to buy 76 units in Wiley, Texas.
Oh, wonderful. How nice. I know that's the power, like where I am today with close to $1 billion in portfolio now. It's because of syndication. And that's what I've been teaching my university and everybody. And I always say that to everybody listening. Go for 5 units or more, because that gets you in commercial side of it. Up to 4-unit, 4-plex is residential, but then go for 10, 15, 20, 50, 100 units, because once you start moving in that direction, your financial freedom will be closer to you. Yeah.
Absolutely. Yeah.
So how do you really determine you are in Plano, Texas, but did you go close by to get your first deals, or what was the whole thinking behind it? Yeah.
Sure. Yeah. So the first deal was definitely near home, like 35 minutes away. And that being, it was a syndication deal. So we raised $825K from myself and other folks.
Yes.
So that one, your first one, I do recommend it being pretty close. Your second one, maybe not, but the first one definitely, because you're learning, you're cutting your teeth, and you want to be able to go to the property if you need to very quickly. So
For sure, for sure. If somebody's starting out, what would you give maybe 3 steps? I know it's all in the mind first. You got to be just ready because most people are W-2 people
Right.
and they are trying to do it to a side hustle. But
Right.
some people just tip their toes, but some go big time. And looks like you have gone big time and you're seeing the results. Yeah.
Yeah, I mean, I always tell folks, I think a bigger property is easier to buy than a smaller one, just because there's a lot of reasons, financing, management, all these things. But for me, it was always, I didn't want to be drugged down into the day-to-day operations, because if you do that, if you buy too small of a property, you can't afford that full-time property management. So that's really why I got pushed to syndication, because I didn't want to buy a smaller property. I wanted something with a full-time manager, full-time maintenance person on site. And so that forced me to do syndication. So that also forced me to go, because I was dealing with a lot of other people's money and I want to be a good steward. I did those 2 passive investments first to learn the ropes. And you need to do that. It's you manage, or anybody managing other people's money. That's a very big role. It's a lot of responsibility. It has to work, right? So for me, it was that education that I learned through passively investing in those 2 deals. And then I felt like I was ready to go. I had built the team up enough of who the insurance company is, the mortgage broker, the general contractors. Like, you build that through doing those passive investments, or you can do that through those if you're pretty active and ask the right questions.
I love it. I love it. What you're saying is I just parallel to you. I have done, this is so true. I think the biggest thing was we were in single family homes, but how much can you invest to get, like you said, smaller number of units? You have limited revenue coming on the top, so many expenses, and the cash flow could be there or could not be there actually.
Right.
But
yeah.
I know in my coach, he says, Vinney, if you go big, it's just extra zeros on the right side.
Right. Exactly. That's right.
Which is so true. One transaction, one broker, one deal, one LLC, one loan, right? Everything is one. But then if you're able to raise extra money for down payment, because that's the biggest drawback, right? To get a smaller property or bigger property is the down payment, closing costs, of course, then the acquisition fee or whatever we charge, in that. But the key thing is by having that synergy to get other investors. And the biggest part is that, you don't really beg for money. You bring great deal. Then investors, friends, family, everybody wants to invest in there to get good returns, right?
Absolutely. Yeah, exactly.
So you bring investor as your equity partners with cash flow and like that. Do you want to throw some light on that? Yeah.
Yeah, sure. So, I mean, syndication has been around for a very long time. I would say it probably caught on more popularly about when Vinney and I got started. That was a big push. It was no longer a bad word to tell a broker that you're a syndicator. It used to be that way.
Yeah.
Now it's not as big of a deal, but so syndication is where you bring people together and you're able to pull your money to buy bigger assets. They're not always better, but what you do get with the bigger assets is a more professional management. It's more stable. If you have 100 units, you have 5 people move out, you don't really notice it. If you have 50 units, you have 5 people move out, it's a big deal, right? So there's a lot of reasons why going bigger is better. You can go too big. I've seen a few people do that, but at one location, but that's a pretty high ceiling.
So true.
Hi, you are listening to Syndication Made Easy podcast. We will be right back after this short break.
Hi, thank you so much. This is Vinney Chopra, and thank you for subscribing to my podcast and YouTube channel and Facebook pages and all the great things, and LinkedIn. Connect with me. I come live to you every Friday at 9 Pacific with Vinney and Bo show. Please also look at that. And also the podcast, which is my apartment syndication made easy. The book I wrote a couple of years back became international top seller on Amazon International now. And then we like to bring great guests for you every week or twice a week sometime to give you a lot of great knowledge. So please subscribe. You give us 5-star reviews on the iTunes. the better the guests we can, bring, and our ranking will go higher also. Thanks again for following us and really getting the most out of it. Please comment, like, share, because we would love to bring better and better material for you. Now, let me talk about diversification. You mentioned, you're telling your investors to diversify. Take us in that path. Yeah.
Sure. Yeah. So we still buy existing multifamily. That's where we started out. We still buy that today, A class all the way down to D class. I'm one of the few that tells people that I buy D class assets. Well, we do take those to B and A class, but I'm the one that admits it's a D off the bat. But anyway, so we buy those. We still buy those today, like I said. But 6 years ago, we had a need from some of our investors that wanted just a monthly, basically fixed income or a very steady, stable monthly payout. And multifamily, as you know, Vinney, is very operational heavy, right? So you got to chase rent and you got to fix toilets. That's what I tell folks. Like it's up and down every month. So, but every quarter we do quarterly payments on those because it smooths it out, right? So what could we do to do a monthly, very steady, stable income option for our retirees or those that need that in their portfolio? And so we started this triple net fund. So we went out and bought $7 stores in a fund. And that really, those are great because you get guaranteed rents from Family Dollar, Dollar General, Dollar Tree is who we had in that first fund. Now we've expanded to Walgreens, CVS, Advanced Auto Parts, those kind of stores. But they pay you on the 29th of the month for the rent that's due on the first. They take care of 95 to 100% of all the operational expenses. So it's a very smooth, stable operation. So there's that piece. And then opposite of that is development. So we do ground up multifamily. And then now we have, we're kind of making a name for ourselves, but we now have 9 downtown office towers we've bought and are converting to multifamily.
Wow.
So those are, I don't know, 350 million of just those alone of construction right now for office to resi conversion. And those are, development is all about appreciation the first 2 to 3 years, no cash flow. But we're trying to double their money in that 2 to 3 year window. Big cash out refi, 75, 80% of the money back by year 2 or 3, and then it cash flows quarterly. So there's just different options of what our investors needed and wanted. Some wanted to mix it. Some of our development deals are in opportunity zones. Some are, some people need the cost seg, so they want the existing multifamily. So it's all just, every investor is different and of return type and tax yield that they need.
I love it. I love it. Are you all in Texas, or have you branched out to other states also? I saw 4 states, right? Or 6 states or something? No.
Yeah. So for our multifamily and development, we're in 4 states. We're in Texas, Ohio, Georgia, and Oklahoma. And then for our triple net fund, we're in 16 states. We don't, for multifamily, you have to worry about landlord friendly states. So we worry about that. So we stick to those 4, but triple net, no one's trying to cancel Dollar General's rent. We were in 16 states right now with those type of assets.
I love it. I love it. Can I dig into it? Because,
yeah, sure.
I've heard quite a bit about triple net. I have a very good friend in Las Vegas also who develops these. And actually a lot of them even ask him to build it. And they are the anchor people coming in, So share with me, so is it easy to get into the triple net, these assets, you buy them and then you're leasing them, or they are about certain percent occupied? What kind of loans? Kind of take us that route. Yeah. Yeah.
So all of ours are hard credit tenants. Almost all of our tenants, except for one, are also publicly traded. So those are who guaranteeing our leases. So that's kind of what we go after. There's obviously medical office, you could do strip malls, all that, but we stay away from that. So not that it's bad or anything, but we just like the high credit stuff. It just draws to us, you're going to get paid. And so, which is a huge deal. And so when you're underwriting these deals, it's different than multifamily. Who guarantees your lease and how long that lease is, the remaining lease is a huge indicator of the value of the property. So if you don't have a high credit tenant, you shouldn't buy it at a higher cap rate because there's probably more risk. If there's 2 years left on it, there's going to be a higher cap rate because there's more risk, right? So, so that's why we like to buy them at fund. We spread them out on that. We're looking for each fund. We try to do about 7.5, 8 years average lease term length. We have bought some of those 1 or 2 year properties with a lease left and have just crushed it on those. but those are kind of spicy. So this is for monthly income. So we try not to do too many of those, but it does juice the numbers quite a bit when we do that. And then really the underwriting is so much simpler than multifamily because you know your rent, right? The blessing and curse of triple net is your rent for 7-10 years, whatever it is, that's fixed, right? So you know that, then you go out to the bank, you know your mortgage payment, that's going to be a fixed rate interest payment. Usually they're 25-year amortizing loans, so a little bit shorter on that than multifamily. But they're all fixed rate because we're going to local and regional banks. So you get a fixed rate mortgage, you got a fixed rent. It's not rocket science. You just take the difference and that's what you're cash flowing every month. So it's pretty easy on the underwriting piece. You do have to change look a little bit different. Like I said about multifamily, you need to see who's gonna, if that Dollar General, whoever it is, doesn't want to renew, who are you going to replace them with? So where's the closest Family Dollar? The Dollar Tree. You'll have Advanced Auto Parts. They'll move up to a bigger store like a Dollar General, right? And then so you need to know that kind of stuff. And then traffic counts are huge. You need to know that. And then the median income is also something that these tenants look at big time because they need to know how much these folks are going to spend at their store, right? So it's a little simpler on the underwriting, but you have to think like a retailer would. So
I got it. And triple net lease, for those of us who don't know, triple net means that the tenant, they are paying for the insurance, for also the taxes. Is that right?
Yeah. Property taxes. Yeah.
And property taxes, insurance, and maintenance also, right? No. Huh? Yeah,
absolutely. Yeah. So some of them are really triple net. A lot of ours are double net, which means that's at some point or at one of those things we have to pay, usually on the operation. So like the worst case scenario is our Family Dollars that we own. So that one, they reimburse us for property taxes. They reimburse us for insurance. The four things that we're in charge of on those are the roof, structure of the building, the parking lot, and then usually part of the HVAC, not the full HVAC, but part of it. So that's kind of worst case for us.
I see. Beautiful. And you have expanded, being company in Texas, you are in 16 states. So it looks like these are special brokers then who have these deals, and you build relationships with them, and they come up with you just give them, hey, we are only interested in double net and triple net, and this is the price range or the cap rate. How do you?
Yeah. It's really about cap rate because we know about what interest rates we can get, and so it's the arbitrage between your cap rate. And that's a jargon word. Sorry. The difference between your cap rate and the interest rate is basically how you know how much money you're going to make on that deal or cash flow.
I love it. Now, again, is there an inflation factor also? Like if they're paying X amount this year, that the rents will increase by 3% or something next year and all, or no?
Yes, there is. Those are baked in. Usually like the first part of the lease, the first section of the lease is usually 10 or 15 years long. And then after those renewals, there's inflationary pushes on that. They're probably not going to be as much as inflation as we had on multifamily. So there's some miss on that. But you're really buying these for that monthly cash flow. I mean, that's what you're doing that's what that's trying to fix is your monthly cash flow problem. You'll have some appreciation, but you won't capture as much of the inflation as you do on multifamily.
Wonderful. I'm thinking, my mind is also working. People who are watching us or listening to us, they might be thinking, okay, what kind of money purchase price level? It may sound, that it's a good deal. Like you want to be in the 100 unit or plus, like you said, with syndication. With this one, the loan to value is usually 65% LTV, or how?
Usually, well, we can, because of interest rates have gone up. We just closed the Walgreens today at a 40% loan. And then that was
40%
on choice. Like I wanted to
lower
because it's more costly to borrow it right now. And then we'll just do a refi next year when interest rates are lower, right? So, but in the past though, when interest rates were great, we were getting 75, sometimes even 80% leverage.
Wow.
And locking in 3-4% interest rates for that period. So you have to change with the environment, but you can get 75, sometimes 80% leverage if you want to.
Oh, wonderful. You mean Fannie and Freddie give those loans or
Oh,
CMBS
absolutely
loans?
not.
No.
No,
Ah,
Fannie Freddie
no.
don't get it. No, so we're going to like regional banks,
Okay.
local banks. We got a guidance line from a regional bank. So basically they approved us for 30 million last year. And if it hit these parameters, we can close within like 30 days. It was
Oh,
beautiful.
wow.
So it really
Awesome.
set us apart from some of the other buyers out there by doing that.
Oh, beautiful, beautiful. That way you can take immediate action,
Right.
come and then, the seller wants to sell it, or give you the lease, actually. It's a lease.
Right.
Oh, you buy, no, wait a minute. So you're buying them with the leases intact, but
Absolutely.
then you will renew the leases. That's what I thought.
Exactly.
Right.
Yep. Yeah. So I'm buying the building. We don't operate a Family Dollar. You don't want me
No,
doing
just
that. So,
Yeah.
so we just own the real estate, cash the check. So
I love it. I love it. This is amazing. I'm so glad that, we dug into it a little bit. I know I've been thinking about, I never have done any, by the way, in the last 17 years.
okay.
I've been multifamily, assisted living, now senior living, multifamily I'm building, and hotels. I got into hotels now
Okay.
also, buying them and all. And then build to rent is another one which I'm planning on doing with the townhouses and all. But triple net lease, this commercial, especially medical centers and
Right.
like you said, Dollar Trees and other strip shop. I don't like big ones, strip malls. Some
Yeah.
people like them. They're very big, but now with online sales happening and all that, they're a little bit more risky, I guess,
Yeah, they can be like, so, and that's why we were drawn to the single tenant. So all of ours are just standalone stores that we've bought so far.
Oh, I see.
And the reason why we do that's the only reason we do a fund is because we want investors spread over multiple stores. So our last fund we closed out at the end of last year, a few weeks ago. Those investors are spread over 26 stores.
Oh, wow.
So
Okay.
So it's because it's like investing in single family. If you buy one single family rental, that's the most risky part of your business. If you own three, it's much better because if you have one vacancy, you're 100% vacant. So
Sure.
that's why we did the fund model on those.
Oh, that's awesome. So are you saying then your minimum is like 50,000 or 100?
Yeah, 50K is the minimum. So yep.
Yeah. And for 26 of these locations, how big was the fund then? I'm just
We raised 20 million.
20 million. Awesome. So
Yeah.
20 million and you're able to buy 60 to 80 million dollars worth of goods.
Right.
Yeah, beautiful, beautiful. All right. No, that's very exciting. How much square footage wise? So if it's a Dollar Tree, it's like how many square foot would that
It's
be?
about 8,000, 9,000 square feet on those.
8 to 9.
Your advanced auto parts are about 5 to 6, and then your Walgreens and CVS are about 10 to 12,000 square feet
Oh, wow. Wow.
per store. So
Amazing, amazing. You have given so many great nuggets. I appreciate that, Kenny.
absolutely.
How about anything you want to discuss in the operations side? So you are also operating, your team is operating and everything, and the finance and everything, I mean, I was going to say, accounting department, let's say, right?
Sure. Yeah.
And all that. How about cost segregation? Do you do any of the cost segregations? Or?
Absolutely. Yeah. This last year was the best of the best. This year will be slightly
80%. Yeah, 80%.
but it's still worth it doing it. So
it is.
So we do it on both our triple net and our multifamily on the cost segs. And we actually even do them on our office towers that we bought. So we buy existing buildings, you can cost seg it, get some depreciation right off the bat.
For sure, for sure. This is amazing. You said $350 million project. Now, these were several towers in one downtown in the opportunity.
No, we're in multiple downtowns. We have 2 in downtown Cleveland, 2 in downtown Atlanta. We're buying 3 in Dallas Fort Worth right now.
Oh, wow.
One in Columbus, Ohio as well. And then we actually just closed on our first suburban office tower to convert to multifamily. And so that'll be our first one outside of a downtown area that we've done. You can still walk to a Starbucks, you can walk to the theater, but it's just old vacant building that's been sitting there for 10 years. And we can repurpose it, bought it super cheap because these office guys are sweating a little bit.
Yeah.
So we can repurpose it and breathe new life into this building.
Oh, I love it. I love it. This is exciting. I mean, these towers might be pretty high cap rate, I think, because they want to kind of get rid of them and sell.
Absolutely,
And
yeah.
then, so what kind of cap rate? 10, 12 or something or more?
Well, I mean, some of them are probably going to be negative, just because the NOI is not there, right? So like one of these we bought was 100% vacant, so it's a 0 NOI. So how do you do the math on that? I don't know. But that's okay. I mean, we're buying it to convert it. So we actually want it as vacant as possible because it's easier.
Totally. You can do much better, quicker, faster. Yeah,
and we've actually done some joint ventures. We've had 2 office owners just stay in the deal. They rolled in a little bit of their equity.
Love it.
So it's a win-win. They didn't lose their shirt. Some others we bought outright from them. They're ready to move on, but some wanted to stay in it. They didn't know development, and they were scared to death of leasing to multifamily people. I told them I'm scared to death of leasing office. So, I guess we'll just stick to your lane, but it was good for them. It was a win-win situation from those owners.
Excellent. Hey, that's been so exciting catching up with you, Kenny. Any books you're reading? I asked towards the end about any apps you're using or stuff. Please share. Yeah.
Well, so I'm a history buff, so it's not related to real estate, but there's a book called Gone to Texas that I'm reading right now. So it's the history of Texas. So reading that, it's a very big book. But anyway, so reading that right now, apps that we're using, our office is, pretty big into Slack. That's a big deal. It's communicated across all of our team, which we need. I mean, we've got 3 different arms of our company. And sometimes in our development deals, we have triple net. The bottom floor will be a Dollar Tree or a restaurant, so they can talk to our triple net group. Multifamily operations can help development on the design of the building. So there's a lot of cross-pollination we need. And so Slack's been very good at that. To make sure everybody communicates well. Awesome.
I know Asana, Slack. I mean, all these are wonderful.
Tons of them, right? Yeah.
Yes. Hey, thank you so much. Again, what motivates you? Get up in the morning and, you're working and what motivates you? Yeah.
I just love what I do. I'm so fortunate to do what I love every single day of my life. So it's a lot of hours, but I don't consider it work because I have a smile when I walk in through the door. So it's fun. We have a growing team here. It's fun to see everybody grow with the company, see us take on these big office towers and reimagine them, repurpose, be part of a big come back to some of these downtown locations. And also, at the end of the day, it's creating massive value for our investors. Yeah. I get goosebumps when I get some of the thank you cards and, some of those, pats on the back from them. And it's just great to have that big effect on somebody's retirement and their life,
So true. What you just said, bro. Oh my gosh. You hit the nail on the head. When you get those cards, we send those gifts, around Thanksgiving. My daughter does it and all. And they take those pictures of the tier boxes on their table. I know they said, oh my gosh, this filled the whole office here, I mean, those are, and the notes and videos and all testimonials. No, that's so great. That just tells you that you are making a difference. You're making a difference in their livelihood, in their living a good financial life, definitely. At the same token, I love the syndication world because it's pretty transparent, honest, and all those things, and everything is, legally done, which is very good. And, so that's not a Ponzi scheme or anything like that, which is a huge part of the game because, you want to really underwrite well and deliver the, value and everything. Yeah.
Absolutely. Yeah.
No, hey, enjoyed the time. I hope you did too. How can people reach you? Yeah.
Sure. So the best place to get a hold of us is our website. So Wolf with an E-investments.com. We put out a weekly educational YouTube video. So if you type in Kenny Wolf, that'll pop up as well. And then we do a multifamily conference 3 times a year. It's not a guru sales pitch. It's just education and networking. So next one is in Houston, February 12th. We'll have about 600, 800 attendees.
Really? That
Tom
many?
Millwright should be there. Bob Helms should be there to speak in the morning. And then we do breakout educational sessions from CPAs, management companies, insurance, the whole gamut. And then it's just a lot of business cards to hand out. And I lose my voice Friday night at the VIP event and Saturday night just until the last man standing. So
I love it. I love it. I wish I could come and meet you there, bro. It's coming up. When did you say? In February? Though?
February 12th.
Oh, 12th. Okay.
Yeah. And then we also hit the East Coast and the West Coast. So we were in Seattle in July, and then we did Atlanta in October. So
Marvelous.
East and West Coast. And
nice.
Atlanta's the East Coast for us in Texas. So anyway. We'll pick the East and West Coast and announce those here soon.
Excellent. No, that's great. I'm so glad that you came on the show, and I think you've given so many great nuggets. I hope everybody really, if you like this whole program, what you just listened and watched, please share with one person, just one person who's looking into triple net leases, who's looking into, diversifying. This is the way to really do it. So thanks again for watching, and appreciate Kenny for coming on the show. Thank you again, for joining Vinney Chopra this week on this podcast. And please subscribe, share, give comments, and give 5-star rating if you can on iTunes, because that really helps a lot for us to bring great guests. And also iTunes raises our rankings up. And I hope you have been very happy with Vinney Chopra and team, who are able to bring great information. If you would like to invest with us, please go ahead and go to vinneychopra.com/invest. Thanks again. God bless you.